Hey guys, what's up? I'm Erin and welcome back to the channel. Since the start of 2022, the word on everyone's lips has been recession and talking about this looming recession because it felt like it was just a matter of time before it would hit. After all, we had those 2 consecutive quarters of negative GDP, but through it all we had very robust consumer spending and very low unemployment, and those things kind of served to prop up the economy a bit and perhaps help us sidestep a recession. Today, those headlines look very different. Now the narrative seems to be that the odds of a recession in the next 12 months are highly unlikely, and we're gearing up more for a soft landing, no recession. Now, of course, no one knows for sure what's going to happen in the next few months or in the near future. And while the Fed and many financial institutions may be taking a more optimistic viewpoint, you can't say for sure that we're totally out of the woods of a recessionary threat and on to sunnier days. The Bank of America did give us some figures to work with when it comes to future probabilities, putting the probability of a soft landing at 45 to 50%, a mild recession at 35 to 40%, and the most optimistic outcome, stronger GDP growth going forward, 10 to 15%. As Carolyn McClanahan, a CFP, put it, sometimes we have recessions when you least expect it, and then you have booming economies when you least expect it. So while a soft landing may be looking more and more likely, it doesn't mean we're totally out of the woods of a mild recession just yet. After all, inflation still sits higher than the Fed's target rate of 2%. And while it did just dip below 3% in June, the July measurement ticked slightly upwards, coming in at 3.2%. And this is the first upward trend we've had in over a year. And these ongoing strong inflationary pressures are why the Fed has continued with rate increases, and at least one more rate increase is expected before the close of 2023. So what does this mean for you as an investor? How can you protect yourself from a mild recession or a soft landing? And what do more rate increases mean for you? As inflation comes down, that doesn't mean that prices will come down. Rather, what is more likely is we'll see prices stabilize. So a lot of consumers are still going to feel that pinch. And we see this right now in every single category from groceries to housing. So for consumers to start to feel like they're getting some breathing room, they're going to have to wait for their wages to catch up, and that could very easily take a few years. So now more than ever, it really puts an emphasis on having a budget and knowing exactly what is happening with your dollars, finding a way to cut back where you can and boost your income where you can, finding a way to stretch your dollars so that pinch doesn't feel as drastic. Hold on to your job. Unemployment sits at notably low levels, around 3.5%, and has remained at these levels for more than a year. But there's no doubt the labor market is cooling. Many companies have announced that they're halting their hirings right now, or they're hiring a lesser number of people than they otherwise would be. And many companies have actually announced layoffs. The Bank of America is projecting within the next year and a half, unemployment will tick upwards towards 4.3%. The best thing you can do is to hang on to your paycheck. Your paycheck and your earning potential are your greatest asset to not only just being able to pay your bills, but also being able to set aside money and build wealth for your future. Think back to your high school days for a moment. Remember Maslow's hierarchy of needs? If you lose your paycheck, it becomes incredibly hard or impossible to meet your very basic needs, to pay for food or clothing or shelter. You kind of get stuck in fight or flight response if you can't meet your most basic needs, and you certainly can't progress on to those next stages of life. No matter what is happening in the market, keep investing. Whether the market is going up or down or sideways, keep dollar cost averaging right into your investments. This year has actually been a pretty darn good one for the stock market. We did experience a slight dip when the Fed announced its rate increases at the end of July, but that kind of behavior should be expected because a lot of investors take dollars that would otherwise be invested in the market and instead invest them in cash or cash-like equivalents, locking in these guaranteed higher interest rates when they're able to. But these headlines announcing that the market is up today or down today or unchanged really aren't helpful to you as an investor and serve more to fill space. When the market is down and you continue to purchase, those dollars end up being some of your most powerful dollars because because you're buying when the stocks are on sale. When the market eventually recovers, you actually end up getting the greatest profit on those shares. Then when you purchase when the market's up, odds are that the market is going to be up a lot more in 5, 10, or 20 years' time down the road. So today will look like a bargain. Reacting to what is happening in the market by pausing your contributions or pulling money out of the market is really just going to be a disservice to the future you and your success as an investor, as 78% of the stock market's best days occur in a bear market or during the first 2 months of a bull market. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half. And missing the best 30 days would have reduced your returns by an astonishing 83%. The best practice is simply to stay invested no matter what is happening in the market or the economy. The Fed's surprise rate hike in July brought interest rates to their highest level we've seen in over 2 decades. And currently, that means you can easily find accounts paying 5% or more on your cash. Think high-yield savings accounts, CDs, money market accounts, T-bills. All of these are wonderful options depending on what your short-term goals are. And if keeping a little extra cash on hand when things are a little volatile helps you to sleep at night, that can be a great step to take because your finances should bring you peace of mind. But remember that even though you can get a good, decent return on cash these days, cash is not a substitute for investing. It's worth noting that many financial professionals and financial institutions are projecting that the Fed may indeed do further rate increases before the year closes out. The Fed has 3 more meetings scheduled before the end of the year: September, November, and December. And while these financial institutions are predicting more modest rate hikes in the near term, in the same breath, they're predicting that rate cuts will actually start as early as 2024. The Bank of America expects one more 25 basis rate hike this year. However, the firm also foresees rate cuts poised to begin in June 2024. The firm's outlook projects cuts of 75 basis points in 2024 and 100 basis points in 2025. Just to quickly touch on basis points and what that actually means for interest rates, if there's a rate hike of 25 basis points, that would increase interest rates by 0.25%. Likewise, if they cut interest rates by 75 basis points, that would bring interest rates down by 0.75%. So say they were sitting at 5%, they would go down to 4.25%. Reducing them by a full 100 basis points would bring them down 1 full percent. So if these projections prove to be correct, in about 2 years' time, our interest rates would be back closer to 3%. So that's why now is a great time to lock in a great rate on your cash because it's unlikely that these rates are going to stick around for the long term. These cash accounts are a great place to keep your emergency fund. Capture a good interest rate on the money you need to keep at the ready anyhow. Ideally, your emergency fund will cover you for 3 to 6 months worth of essential expenses. And knowing that you're covered for 3 to 6 months, no matter what life throws at you, can bring you great peace of mind. And don't touch that emergency fund unless it's an actual emergency. I kind of look at emergency funds the same way I look at Band-Aids. Bear with me here. I bought 1 box of Band-Aids when I became an adult. And when I get a minor cut or something happens, I kind of assess the situation like, is this a true Band-Aid emergency? Most of the time it's not, and I'll just wrap it up in a paper towel, wait for the bleeding to stop, and call it a day. I don't touch those Band-Aids unless it's a true situation that would warrant a Band-Aid. I don't know where this came from or what it is, but I've always kind of thought I would know I've made it financially if I could just use a Band-Aid on a minor cut. So maybe one day I will have that sweet Band-Aid money. I want to know if anyone else looks at Band-Aids this way or if it's just me. There's a chance it's just me, but I am very curious. With interest rates sitting at 20-year highs, now is not the season to be taking on a bunch of debt. But really, is there ever a season for that? Just asking for a debt-averse friend. Credit card debt, some student loans, auto loans, and mortgages are sitting at their highest level we've seen in ages. And oftentimes there are factors that are outside of your control. Like maybe this is when you're moving and maybe you need to buy a home or maybe you need to buy a car. And if this is the situation you're in, you're likely just going to face higher interest rates. It is what it is. But if you have the ability to have a little wiggle room, if you can hit the pause button on these purchases for say maybe 2 years, you're likely to get a far more favorable interest rate. As far as credit card debt, no matter what your interest rate is on your credit card, you should never be carrying a balance on your credit card. You should pay that balance off in full every single month without exception. And if for any reason you can't pay off your credit card in full, pick up the phone, call your credit card company, negotiate that interest rate down. Then get to work paying off this credit card as quickly as possible. Then ditch the credit card, because you have no business having a credit card if you cannot pay off the balance in full every single month. By and large, when the economy is a little shaky, you shouldn't have to adjust your behavior too much. Maybe you get a little bit more conservative, maybe you ensure to hang on to your job. But outside of that, your behavior as an investor should continue forward as it always has done. You don't want to be reacting to the economy. What you want is a solid financial plan that operates well when times are good and when times are bad. What have you done to prepare for whatever is happening? Do you have a financial plan that you follow? Let me know in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.